So hello everyone. I just want to present some information on Chapter 2. Chapter 2, we start getting into more about how finance is related to a company. And we start talking about common stock and venture capital and why companies go public. And some of the terminology as to what is a money market and what is a capital market. So we start getting into that, and I'm going to play this little video here, which this is in your ebook, which you should play. So let's get going with that.
In the previous chapter, we discussed why, in finance, we say that the firm's goal ought to be to make its investors better off. But how do firms obtain money from investors in the first place? In this chapter, we turn our attention to the financial market environment. When we refer to the financial market environment, we're talking about the process by which investors and firms interact so that firms can raise the money they need to make investments and grow, and investors can earn a return on the money they provide to firms that is commensurate with the risks they take. We organize our discussion in this chapter around two main ideas. First, a variety of financial institutions provide services to firms that help them raise money from investors. Those financial institutions include commercial banks, which take in deposits from customers and lend those deposits back out to firms, and investment banks, which help firms raise money by selling securities, such as stocks and bonds, directly to investors. Some financial institutions specialize in providing funding to a particular niche in the market. For example, venture capital firms raise money from individuals and other investors to buy ownership stakes in young, risky startup companies. Those companies are usually too risky to obtain much financing in commercial bank loans. The second main idea in the chapter is that firms interact with investors in financial markets. When a firm sells security directly to investors, we say that the firm is transacting in the primary market. For example, in 2017, the company Snap, which created the popular app Snapchat, raised money by selling stock to investors in an initial public offering, or IPO. An IPO is an example of a primary market transaction because investors bought shares directly from Snap, and Snap received the money from that sale after paying fees to its investment banker. When people invest money by purchasing a firm's securities, they want to earn a return on the investment, but they also want liquidity. Liquidity simply refers to the ability to buy or sell an investment quickly without having much impact on its price. Investors buy and sell securities from each other in the secondary market. Going back to Snap, once investors buy Snap shares in the IPO, they can trade them on an exchange with other investors. In Snap's case, shares trade on the New York Stock Exchange, but many other tech companies choose to list their shares on the NASDAQ. In either case, the stock exchanges provide a venue in which investors can quickly trade shares with each other. In these secondary market transactions, money flows between investors, not between investors and Snap. Those are some of the key ideas in this chapter. Now go read more about how financial institutions and markets help facilitate the interactions between firms and investors.
So somewhere along the line, you may have heard of the term a unicorn. And where did that come from? And I'll read you this little piece here. That's from your textbook. The daughter of Chinese immigrants and founder of the venture capital firm Cowboy Ventures, Eileen Lee added a new term to the business lexicon in her 2013 blog post on TechCrunch. Lee used the word unicorn to describe a privately held tech startup worth more than $1 billion. Prior to 2013, private companies with valuations that high were about as rare as the mythical one-horned equine creature. But by 2017, less than 4 years after Lee coined the term, more than 200 startups had achieved unicorn status around the world. Most of these called the United States home, with the greatest concentration in California's Silicon Valley. One example was the room sharing service Airbnb. See, that was a unicorn, right? In 2008, Airbnb received more than $3 billion in funding from venture capital firms, with the latest $1 billion arriving in 2017. So you can read that, the rest of that yourself. But it's I find it pretty interesting. So you'll notice the word here in financial institutions that's highlighted. And what they are is they serve as intermediaries, right, by channeling the savings of individuals, businesses, and governments, right, which are us, right? The government saves, right, into loans or investments. Okay, well, the government doesn't do too much savings these days, right? So many financial institutions directly or indirectly pay savers interest on deposited funds, but of course they give out loans at a higher rate. That's how banks stay in business, right? I'll give you 0.1% and I'll charge 5 or 6% for a loan. And of course, these financial institutions are government regulated, right? There's a lot of regulatory guidelines here that they have to worry about. So individuals not only supply funds to financial institutions, but also demand funds from them in the form of loans. So individuals as a group are net suppliers for financial institutions. They save more money than they borrow. But businesses, on the other hand, are the net demanders of funds, okay? You see this in italics here, okay? So there's a couple different types of banks here. And a commercial bank is a financial institution, and they provide savers with a secure place to deposit or save funds for future use. And here are a couple, like JP Morgan Chase, Wells Fargo, Bank of America, Citibank, U.S. Bancorp, PNC Bank. So these are some, right? So they provide loans to both individuals and businesses to finance their investments. And this is if they don't want to go public, right, and issue stocks or bonds. They'll go to the bank. So way back and a long time ago, there was this act called the Glass-Steagall Act, and it prevented commercial banks from becoming investment banks at the same time. You couldn't be a commercial bank and an investment bank. So the 1933 Act of Congress that introduced deposit insurance, introduced the Glass-Steagall Act, also created a separation you see here between commercial banks and investment banks, meaning that an institution engaged in taking in deposits could not also engage in the somewhat riskier activities of securities underwriting and trading, because that bank could go under. So I believe if we click on the Glass-Steagall Act here, we may get more. So you can see an act of Congress in 1933 that created the FDIC and separated the activities of commercial and investment banks. Okay. All right. So what's an investment bank here? An institution that assists companies in raising capital, advise firms on major transactions such as mergers or financial restructuring, and engage in trading and market-making activities. So that's an investment bank, and that differs from a commercial bank, right? Investment banks will help companies go public, okay? Eventually, President Clinton in 1999 repealed the Glass-Steagall Act, okay? And banks now were allowed to do this both. So then commercial and investment banks were separated until Bill Clinton repealed the Glass-Steagall Act. And now these banks do the same, okay? And if you want to read this, there's been a major consolidation in the banking industry over time. You should try to answer these review questions here. So you understand the concepts in the chapter. Okay, so we're going to talk about financial markets a little bit here. And basically financial markets here, what are they? We click on this. Forums in which suppliers of funds and demanders of funds can transact business directly. So that's people who buy and sell stocks and bonds, basically, right? So there's two key financial markets. There's one called the money market. The money market is for securities less than 1 year, and the capital market is for long-term securities greater than 1 year. So short-term debt instruments or marketable securities are going to trade in the money market, and long-term securities, bonds, and stocks are in the capital market. Now, what's a private placement? So the private placement would be the sale of a new security directly to an investor or group of investors. This is not when they're not public, okay? And that differs from a public offering, where the sale of bonds or stocks is to the general public. So there's a difference here between a private and a public offering, okay? All right, so when a company or government entity sells stocks or bonds to the investors and receives cash in the return, that's called a primary market. That's when the company itself, through an investment bank, is selling new shares, okay? So let's click on the primary market. Financial market in which securities are initially issued, the only market in which the issuer is directly involved in the transaction, and the issuer would be the company through an investment bank, okay? And what's the secondary market? The secondary market is when you and I trade amongst each other, okay? You have shares or I have shares, and we buy and sell from each other. So please make sure you understand the difference between the primary and the secondary market, okay? So here's a nice little graph that shows you how money flows, and here's supply of funds, savings going into the financial institutions, okay? And here's the supplier taking some of their money out. And here's, funds, basically people putting money in the financial markets. They're buying securities, and they get securities in return, okay? So here's a private placement versus a financial market. So this is where, private companies, money's being demanded, and the supplier of funds are going from private placements. This is a company that's not public, and they're borrowing money to, such as Airbnb did, okay, as we talked about previously. All right, so I'll cut this off here because these get a little large, and I will do a part 2 on this, okay? And we'll pick up with the money market.